Welcome back. Previously, we have gone through the concept of risk and different types of risk. Let us discuss how the risk can be analyzed and how the decisions are taken by the decision maker during various situations. Risk analysis. The term risk analysis itself means how a risk can be analyzed. The acceptability of project depends upon their returns and risk. A firm should consider risk while estimating the required rate of return on a project. Generally, there is a positive correlation between risk and returns. The main duty of every decision maker is to take proper decisions, usually the decision making in the form of where to invest or how to invest. So whenever a decision has to be taken with regard to investment, the manager or the decision maker has to make sure that whether the organization is getting returns or not. If there is higher returns, it means it will be followed by risk. So there exists a direct relationship between risk and returns. Whenever the returns is high, risk is also high. Whenever the returns is low, the risk is also low. So before investing funds in a project, it is necessary to consider the return and risk associated with all the alternative investment options. Because a manager will be facing different opportunities, means a businessman or a manager can invest in share market, or he can invest in the real estate, or he can invest in any other fixed assets. So where to invest, that is the main point that has to be considered. A manager should invest in an opportunity in which he get maximum returns. But there is one issue: whenever there is maximum returns, there will be risk. So it is the duty of the managers or decision maker to analyze the risk properly. That is the concept. So the process of comparing the risk and returns to select the most profitable investment proposal is known as risk analysis, or in other terms we can term it as risk return analysis. Not only the risk has to be considered, at the same time return has to also to be considered. Thus, the objective of risk return analysis is to select the best project or investment proposal. The best project is the one which has the highest return and lowest risk, and that is a very scarce event to happen. As we have mentioned earlier, risk cannot be eliminated completely from any financial or investment decision. However, it can be minimized through proper risk return analysis. I hope you all learned about the term capital budgeting. Capital budgeting means investment in fixed assets so that return in such investments will be received in somewhere in future. So, risk in an investment refers to the variability that is likely to arise in future between the estimated returns and the actual returns from the investment proposal. So, it is a duty of every manager to assess the risk and take the proper decision with regard to investment, because decision making in this area is of an integral part for financial analysis. That is the concept. So how a manager is taking decision? Right now we have mentioned that any investment opportunity that provide maximum return with minimum risk can be selected. For theory we can say very easily, but in practical point of view it is very difficult. So manager has to use different techniques for identifying or analyzing the risk so as to make proper decisions. Next, we will be learning various techniques for decision making under risk and uncertainty. Usually, it is a problem area where we will be studying different methods regarding where to invest and how to invest. And with regard to technique for decision making under risk and uncertainty, I hope you all learned about the concept capital budgeting. And in the capital budgeting, you have learned various methods for decision making. And the same methods are studying in this area also, but in advanced form. So let us discuss some of the methods. The total techniques which we are going to learn is classified into two major categories, that is traditional techniques and modern or statistical techniques. So let us discuss in detail traditional techniques. Under traditional techniques, first one is risk adjusted discount rate. I hope you have heard the term discount rate, otherwise known as discount factor. You might have learned the same thing in the capital budgeting area. Usually we use discount factor or discount rate so as to find the present value with regard to decision making. Usually a firm is ready to accept a lower rate of return from a project if the risk involved is less. If there is more risk in an investment proposal, high rate of return shall be expected. Under the risk adjustment discount rate technique, some adjustment will be made in the discount rate otherwise known as present value factor. This is done according to the degree of risk associated with the project. If the risk is high, the discount rate is raised. Discount rate is raised by adding risk premium to the discount rate. In simple terms, it means there will be a present value factor or a present value rate with regard to investment, and if the risk factor is high, there will be a risk premium or a risk percentage that will be added to the present value factor. That is the concept. So risk adjusted discount rate is the risk free rate of return plus risk premium for investing in the risky projects. For example, if the management desires a rate of return of 12%, if the project is risky, a risk premium of 3% will be added to the 12% to provide for the risk. Thus, the total risk adjusted discount rate will be 15%. So, risk-free rate is the rate at which the future cash inflows should be discounted if there had been no risk, whereas risk premium rate is the extra return expected by the investors over the normal rate or the risk-free rate. You will get a clear picture when we are dealing with a practical problem. So, higher the discount rate, that means the projects are more risky. Lower discount rate means the project will be less risky. And decision rule. Remember, in this module we will be discussing different types of problem areas, and at the end of the problem you need to make an interpretation. If you are familiar with the methods which you have learned in the case of accounting for management in 5th semester BCom, in that case you will be making an interpretation after each problem. Just like that, in this case also you need to make interpretations. With regard to a problem relating to risk adjusted discount rate, the decision rule is usually you will be following a NPV method or a IRR method. I hope you all know what is meant by NPV and IRR. NPV means net present value method and IRR means interest rate of return method. So usually you will be using the method NPV. So how we are going to take the decisions? If you are dealing with a case where the NPV is higher, then the project is selected. If the NPV is lower, the project is not selected. If you are dealing with a question where IRR method is used, the project with the IRR greater than the risk adjusted rate of return, in that case that particular project will be selected. If you are familiar with the NPV and IRR methods, you will get a clear picture. So let us discuss some of the merits and demerits of risk adjusted discount rate. I hope you understand the concept of this risk adjusted discount rate. The first merit is it is very simple to understand and easy to calculate. We will discuss a problem area, then you will understand clearly the concept of risk adjusted discount rate. It is very easy to identify and compute. It provides compensation for the risk factor. Yes, exactly. Every investment or project or any project will have a discount factor or a present value factor, and apart from that a risk percentage will be considered in each and every project. So this method consider the risk factor. It can be used with NPV and IRR. We all know what is meant by NPV and IRR. NPV means net present value method and IRR means interest rate of return method. This method can be used simultaneously in both the cases. Here this method considers risk rather than the attitude of investors. Attitude of investors means investors may or may not invest. If you consider the attitude of the investor, we will not be able to invest in a project. It is usually investments is made on the base of risk factor with regard to the project. Higher the risk means investment will be higher and the returns will also be higher. Apart from that, this method suffers some sort of demerits. First one, it is not a scientific way of determining the risk premium. We have mentioned an example that certain rate of return from a project is 12% and the risk with regard to that project is 3%. So if we add both the percentage, you will get the risk adjusted discount rate. And the method for identifying the risk factor or the risk percentage, there is no scientific method for identifying that. It is just an assumption that this percentage will be given to such as risky projects. Higher rate will be provided to risky project. There is no scientific method of providing the risk rate. Usually it will be subjective and controversial. Subjective means usually the decisions are taken and it may vary depending upon the nature of the decision maker. So it is always subjective. Adjustment is needed in cash flows and not rates. Means here the decision with regard to investment is done on the basis of present value factor and risk factor. No adjustment is made in the cash flows with regard to the investments. Assumption about risk is wrong. Yes, exactly. There is no scientific method for determining the risk premium, and at the same time assumption about risk also is wrong. There is no scientific method for setting the risk factor with regard to an investment. Let us discuss the same case with the problem area, then you will get a clear picture. Arun Limited is considering a new project. There are two alternative proposals are available, X and Y, each costing 5 lakhs. Cash inflows are expected to be as follows. Cash inflows of project X and project Y is given. For 4 years, the cash inflows of the project for X and Y is given, and in the question it is said that the initial cost or the initial cash outlay is 5 lakhs. The company has a target rate of return is 10%. The risk premium rates of X is 2% and Y is 8%. State which project is better. So in the question there is no mentioning regarding which method has to be followed. Remember, whenever there is no specification regarding which method has to be followed, means either you have to use the NPV method or IRR method. If there is no mentioning about the method you have to follow, automatically you go with NPV method or net present value method. I hope you are familiar with the method. If you are not familiar, you will get a clear picture after discussion of this case. So we were discussing about risk adjusted discount rate. The concept is that every investment will have a minimum rate of return, otherwise known as cost of capital or return on investment. Likewise, here for investment in X or Y, the minimum target rate of return is 10%. The company is expecting 10% return for this investment. And at the same time, risk premium is given 2% for X and 8% for Y. So the present value rate is computed by adding the target rate of return, otherwise known as risk-free rate of return, plus the risk return. So for X it will be 10 plus 2, that is 12%. So for the base of 12% you need to find the present value factor. So how you are going to find the NPV? Here for project X, year and cash inflows are given. For the first year it is 1,80,000, in the second year it will be 1,50,000, and the third year it will be 1,20,000, and in the last year it is 1 lakh. And initial investment, it was said that 5 lakh will be invested. So how we are going to take the decision? The concept is that if you are using the NPV, you have to find the net present value. For finding out the net present value, you need to find the present value of cash inflows. Here the cash inflows for the 4 years is given. We need to find the present value of cash inflows. Present value, I hope you all know the concept of present value of cash inflow. That is otherwise known as time value of money. You need to identify the value of money in each of the period. The concept of time value of money is that 1 rupee present in your hand today will be less than the same value received in the past. With a simple example, you will get the understand. If you have 1 rupee now, right now, after 10 years, the value of 1 rupee will be diminished. That concept is known as time value of money. It will be like that. So time value of money is otherwise known as present value factor. For a simple understanding, remember, in case of assets you will be using the concept depreciation. Depreciation means deduction or reduction in the value of the asset. Just like that, in case of money there will be a deduction, otherwise known as discount. So a discount factor has to be considered whenever you are taking decision, because money value will diminish with passage of time. That is the concept. So here the money value of 4 years is given, but you need to find the present value. Present value can be found out by using the present value factor. Here for project X, the present value factor, otherwise known as risk adjusted discount rate, is 12%. I hope you know how to find 12%. So you need to find the present value factor of that 12%. So the present value factor, otherwise known as the discount factor with regard to 12% is, in the first year it will be 0.893, in the second year it will be 0.797, in third year it will be 0.712, and in the last year it is 636. You will sometimes you may find it confusing. What is this? If you are familiar with the time value of money concept, or if you are familiar with the present value concept, then we need not have to go further into that. If you don't know what is the concept, just understand it wisely. So what is the meaning of these decimal values? Here in this situation, the discount factor with regard to project X is 12%. 12% means that 12% discount has to be considered while dealing with the inflows of this particular project. So how you found out this decimal values? Usually it will be given in the question, but in the examination we can't take the risk. You need to know how to find these values. It is very simple. There is an equation for finding the present value factor. The equation is 1 divided by 1 plus r by 100 raised to n. So how we are going to find? In the first year the equation is 1. Usually the denominator, so numerator will be always 1 for each case. 1 divided by 1 plus r. R means rate. Here the rate is 12%. 12 by 100 raised to n means the year which we are going to study. In the first year it will be 1, so it will be 1. Let it be like that. If you know the basic maths, you will get the answer 0.89. Same way, in the second year, the equation is 1 divided by 1 plus r is 12. 12 divided by 100 raised to, remember here n. Here you are going to analyze for the second year, so the n will be 2. Likewise, you need to find for each year. So that is how you have to find the discount factor, or otherwise known as present value factor. If you are familiar with the present value table, if you go through the text, in the last page there will be different tables, and in that you have to go through the present value of rupees 1. That table has to be identified. In that table you can easily identify the present value factor of each rate. So this is the equation for finding the present value factor. Just go through it. If you have any queries, please let me know. So next is you need to find the present value of cash flows. Here cash flows is given. You need to find the present value of cash flow. How we are going to find? It is very easy. Just multiply cash inflow with discount factor. You will get the present value of cash flow. So after finding the present value of each cash flow, you need to take the total. From this total, you need to deduct the initial cash outflow. Initial cash outflow means initial investment. Here it is said that the cost of particular project is 5 lakhs. So if you deduct the initial investment from the total present value of cash inflows, you will get NPV. This amount is known as NPV, otherwise known as net present value. In this project you got a negative NPV. Usually in the NPV decision making, if you get a positive value, the project is selected. If you get a negative value, project will be left out. Since here there are two projects, you need to find out the present value, so NPV of the other project also. Here we found the NPV of project X. Likewise, you need to find the NPV of project Y also, and by comparing that, whatever project having the highest NPV, that project will be selected. So we have found the NPV of project X. Now you need to find the NPV of project Y. The method which we have followed is similar to the case of project Y also. So in the case of project Y, it is said that the company's target rate of return is 10%. Whatever may be the project, the return will be 10%. So Y also rate of return is 10%, but the risk factor with regard to project Y is 8%. So total present value rate or the risk adjusted discount rate is 18%. So we will be doing the problem with the help of 18%. Project Y's cash inflows is given 2,50,000, 1,80,000, 1,50,000, 1,40,000. See here for the each year the amount is given. So next you need to find the present value factor or discount value factor. Discount factor of 18% is, decimal values is already given. I hope you know how to find these values. For examination, if you are lucky, the university will give these values. Otherwise, you need to find these values by yourself. In the previous case, we have discussed a formula for finding. Try to understand that formula and find out the value. Otherwise, you can take a logbook or a logarithm table for the examination. In the logarithm table, there is a page known as present value of ₹1. From that table also you can easily identify the present value of 18% or the discount factor of 18%. There will be a number of percentage values will be given. Okay, let's come back to the case. Cash inflows is given, discount factor is given. If you multiply these two, you will get the present value of cash inflows of project Y. That is 2,50,000 into this rate, you will get this value. 1,80,000 into this rate, you will get this value. 1,50,000 into this rate, you will get this value. Likewise, and finally you need to take the total of all these present value of cash inflows, and from that you need to deduct less cost. Here the cost of initial investment is 5 lakhs. By deducting 5 lakhs, you will get 4,580. You have to deal with this area very cautiously. See, in case of project X you got 70,670, but in case of project Y you got 4,580. that is, whatever the project having highest value will be selected. You have to be very cautious. Don't go with this amount. Here you think that it is 70,000, this is only 4,500. Remember, here it is negative value. Negative value can't be considered. Here it is a positive. Even though it is a smaller value, it is positive. That means this project can be selected. So which project has to be selected? That question is answered here. Project Y is selected because it is having the highest NPV. So this is how you need to take a decision with regard to risk adjusted discount rate if you are using NPV method. Similarly, sometimes you may come across a question where you have to use IRR method. You have to familiarize with NPV as well as IRR. I hope you know what is meant by NPV and IRR. We will discuss about the further cases in the next session. So just go through it. If you have any queries with regard to how to find any of the steps which we have discussed now, please let me know. We will discuss each part in detail.